How much gold and silver should you really own? Let's get straight to the point. If you've been watching what's been happening since Black Monday, you already know the system is cracking. Prices are distorted, the Shanghai arbitrage is out of control, and the big banks are in deep trouble. But right now, I need you to pause for a moment. Stop refreshing silver prices every 5 seconds. That figure you're obsessed with is just a signal, a warning that the system is failing. Here's the real question that matters as we accelerate into 2026. Not what's the price, but do I own enough? And truthfully, for most people, the answer is no. For over 40 years, traditional financial advisors, the ones who profit by selling mutual funds and paper-based assets, have misled you. They told you gold and silver were just a safety net. They said you should dedicate only 5% of your investments to metals, then forget about them. They also claimed metals don't generate returns, can't beat inflation, and are dead assets. That's false, a complete fabrication designed to keep you on the financial treadmill. Today we're going to crush that lie using cold, clear numbers. We'll explore the actual purchasing power of gold and silver. We'll explain why the old 5% rule could be devastating in 2026. And we'll give you a clear, specific target, the exact number of ounces you need to hold if you want to make it through what's coming. We told you this year would be unstable. In 2024, most financial media spent the entire year pushing the idea that the US would liquidate its gold reserves to buy Bitcoin. They inflated the crypto storyline and claimed the S&P 500 was the only thing that mattered. But let's check the scoreboard at the end of 2025. Gold and silver are making their biggest moves since 1979. They've outperformed the S&P 500. They've outperformed Bitcoin, which is down 8% this year. And they're doing all this while the global order scrambles to hoard tangible assets. So it's time to clear the distractions. Let's focus on the real reset in value and figure out how much metal you must hold before the clock strikes midnight this New Year's Eve. A lot of you see silver at $70 and think I missed it. It's over. It's a bubble. You're seeing the market through the wrong lens. This isn't a bubble inflating, it's a reverse bubble popping. You need to understand for the last decade, silver's price was manipulated. It was the only major asset that cost less in 2020 than it did in 1980. While gold has been hitting new nominal highs across every global currency since late 2023, silver has been dragging behind. It only recently surpassed its 2011 peak when measured in Swiss francs. But looking into 2026, silver still has 2 full years of ground to make up. It has yet to break through its inflation-adjusted record. And no, I'm not referring to the government-issued CPI statistics. I mean real inflation. If we adjust the 1,980 high using actual inflation numbers, silver should be priced at least $8.100 per ounce. When you include the expanded monetary base, the fair value climbs to well over $100 per ounce. So, when you see silver priced at $70 today, understand it's only now beginning to return to its true value. The jump from $50 to $70 wasn't a bubble, it was simply a reality check. The U.S. Geological Survey didn't include silver on its list of critical minerals just for show. They crunched the data and saw reserves are dangerously low. They also saw the explosion in AI and escalating military demand. That information came out on November 6th, when silver was still trading under $50. At that point, we told you buy. Now we're at $70, and I'm telling you again, it's going higher. But price alone means nothing if you don't understand value. So let's talk about purchasing power, the number one argument critics throw at us. They claim gold doesn't create wealth, it just sits idle. Wrong. Gold and silver actually lower the cost of living over time. Technological deflation is real, production gets cheaper as computers and manufacturing improve. Yet retail prices never seem to fall because the fiat money system is devaluing faster than technology can make things cheaper. If you measure prices in gold or silver, the picture changes completely. Take the iPhone in 2007, it launched at $599, and in 2025, it's nearly $1,200. In dollar terms, the cost doubled, you've become poorer. But measured in gold, that iPhone has dropped by 75% since 2007. In silver, the cost has declined by 68%. That means dollar savers work twice as long, while someone who saved in gold could buy 4 iPhones with the same metal. This shows metals don't just protect against inflation, they capture productivity gains. They let you benefit from human progress while fiat quietly robs you through inflation. But let's move beyond smartphones, those are luxuries. Let's talk about something truly important, your home. Everywhere you turn, people are frustrated with housing prices. I can't afford a home. The market is insane. It's a bubble. In dollar terms, yes, housing is clearly in a massive bubble. But measured in real money, the housing market is actually in a depression. We went back and crunched the numbers from 1,980 onward. Between 1,990 and 2006, the median American home was valued at about 457 ounces of gold, and that ratio stayed fairly steady for years. Today, with gold rising sharply while real estate stays stagnant in real terms, a typical home has fallen dramatically to just 95 ounces of gold. That's a 53% decline in the real cost of housing since 2007. In fact, we're hitting new lows, and 95 ounces is even cheaper than the average home was in 1980. Measured in silver, the story is just as compelling. The median home is hovering around 6,400 ounces of silver, about the same bottom we saw in 2011. If you're saving for a home using dollars in a bank account, you're running up a down escalator every day, that home gets more expensive in fiat terms. But if you're saving in gold and silver, that same home is quietly becoming more affordable. That's why your metal allocation decision is critical for 2026. You're not stacking for show, you're positioning to one day trade a small pile of yellow coins for a debt-free 4-bedroom house. That transfer of wealth is already underway. The dollar price of homes is rising while the gold price of homes is falling. And the gap between those trends is where real wealth is created. Now the question becomes, how much do you actually need? Ask a typical financial planner, and they'll still suggest the outdated advice: put 5% of your portfolio into gold as a hedge. But in the context of 2026, 5% might as well be nothing. Think about the environment: global debt at 335% of global GDP. The U.S. is spending more on interest payments than on its defense budget. We're in an active currency conflict with the BRICS nations. And physical silver supply is so tight it recently triggered a limit-up freeze on the COMEX. In these conditions, a 5% allocation offers no meaningful protection. If the dollar loses 50% of purchasing power and your gold doubles, you only preserve about 5% of your total portfolio. The other 95% effectively burns to ash. That's not risk management, it's a participation trophy. What you need is functional protection. For most people heading into 2026, the new minimum allocation to physical metals should be 10% to 15% of overall net worth. That is your foundation. And if you're carrying debt reliant on fixed income or worried about job security in an increasingly AI-driven labor market, you should be looking closer to 25%. Why? Because metals must rise enough to offset paper asset damage. When bonds lose value, gold needs to rally to fill the hole. When dollars buy half as much food, silver must double to cover your basic costs. You simply cannot create real financial balance with just a symbolic 5% allocation. And let's be clear, form matters. We're not referring to ETFs here. We're not talking about mining stocks either, although those can be useful for speculative plays. What we're focused on is physical, metal, tangible insurance. That 10 to 15% core position must be metals you can physically hold in your hand. Metal that carries no counterparty risk and remains unaffected whether the COMEX is functioning or not. Back in 2021, when we first raised this issue, we gave everyone a very specific target, the 5 and 2 to 100 rule: 5 ounces of gold and 200 ounces of silver. In 2021, that stack would have cost roughly $14,300. We estimated that amount would cover about 3 months' worth of expenses for the average American family if the system were to seize up. Fast forward to December 2025, and that exact same stack has nearly doubled in value to $34,000. Gold's spot price has surged 138%, and silver is up 136%. So if you followed our advice, your 3 months of coverage has now become 6 months. Your purchasing power didn't just survive, it grew. While most people are panicking over inflation, you've quietly built a 6-month financial buffer. But here's what truly matters: even though prices are higher now, the rule hasn't changed. You still need that baseline. If you're starting from scratch today, your first milestone before buying stocks, jumping into crypto, or prepaying your mortgage is to acquire 5 ounces of gold and 200 ounces of silver. Why 200 ounces of silver? Because silver is your day-to-day transaction metal. If we enter hyperstagflation, you're not going to shave off slivers from a gold coin to buy food. You'll need silver, and 200 ounces gives real transactional flexibility. Why 5 ounces of gold? Because gold is concentrated wealth, your personal savings vault, and a future down payment for a house once the storm passes. Sure, it's harder to reach that goal today than it was in 2021. It costs $34,000 now instead of $14,000. But the price of not owning it could be limitless. This is the nature of long-term financial trends. The earlier you act, the more you stand to gain. If you're still thinking, I missed the boat, I'll wait for prices to dip, you're going against the direction of history. The central banks aren't waiting for dips, they're buying at all-time highs. China isn't waiting for a better deal, they've banned exports. You need to secure your position now. If you haven't reached the survival stack, the 5 and 200 rule, stop watching this video, contact a reliable dealer, and start building your stack. That foundational stack is your financial lifeboat. But if you're already well positioned and want to shift from defense to offense, it's time to discuss multipliers. Beginner-level investors stare at spot price and say $70. That's expensive. Seasoned investors aren't staring at price, they're watching the ratio. Right now, that ratio is flashing a rare signal we haven't seen since 2011. It's called the gold to silver ratio, GSR. The GSR measures how many ounces of silver it takes to buy 1 ounce of gold. It's presented as one of the most powerful indicators in precious metals. Historically, this figure has hovered around 50 to 60 to 1. When it climbs above 80, silver is framed as undervalued. When it drops below 40, silver becomes relatively expensive. That range is used as the lens for cheap versus pricey between the two metals. From October through December 2025, we observed the GSR fall from 80 down to 70. The claim is that this shift matters. Why? Because that move happened as silver jumped from $50 to $60. That's presented as an early stage ratio signal. In a true bull market frenzy like 1980 or 2011, this ratio supposedly doesn't stop at 70. It keeps falling toward 40 and sometimes 30. Now run potential numbers for 2026. If gold reaches $4, 500 to $4.000 per ounce, and the GSR drops to 60, that puts silver around $73 to $33 per ounce. That's framed as the baseline, the conservative scenario. It sets a reference point for what normal could look like in a strong cycle. Now, consider the aggressive outcome. If a physical shortage becomes severe enough to break the market, the ratio could crash to 40 like it did in 2011. In that case, $4 divided by 40 implies silver around $110 per ounce. This is used to argue silver has the most explosive upside. Gold is described as the armor, it shields you. Silver is the slingshot, it launches you forward, so the narrative says tilt toward silver for 2026. The ratio is framed as screaming that silver remains undervalued next to gold even at $70. That sets up the rotation play. The strategy is presented as straightforward: buy silver while the ratio is still high, wait for it to drop to 40, then swap silver for gold. In doing so, you act like your own central bank, using the ratio swing as arbitrage to increase total ounces without spending more dollars. Next comes technical price targets, because up isn't treated as a strategy. The chart is described as crystal clear. The current floor is said to be $58, a strong support level established in late 2025. The next barrier is resistance at $74. Why $74? Because it's described as a Fibonacci extension drawn from silver's 2011 high, the line in the sand that could open the floodgates. That $74 level is the algorithmic line in the sand. Once silver breaks that barrier, there's no meaningful technical resistance until $100 in air pocket where price can move fast. In that kind of zone, assets often move rapidly and aggressively. Silver could jump from $74 to $90 in just a matter of days. Now shift to gold. It's hovering close to its all-time highs, but the key reference is the 50-day moving average. That 50-day line is sitting around $4.100, and it has acted like a trampoline for the entire uptrend. Each touch is followed by a bounce. If we apply the gold to silver ratio and it falls back to the 2021 support area near 65, the 2026 gold target sits around $4.100 per ounce. This is framed as not a random guess, it's tied to the broader debt cycle. U.S. National debt is compounding and interest expenses are compounding. The claim is that gold is tracking that exponential curve. A gold price of $4.800 is presented as the logical outcome of $40 trillion in USS federal debt. Now a serious warning: after hearing bullish projections like $110 silver and $4.800 gold, you might feel tempted to go all in or use leverage. Don't do it. We're entering a period of volatility clustering where calm stretches are followed by sudden violent bursts of chaos. And 2026 is framed as one of those volatile clusters. You could see weeks where silver plunges $10 in a single day. You might also wake up to gold down $200 in the morning because a hedge fund got hit with a margin call. These aren't described as crashes, they're shakeouts. The market is framed as transferring wealth from the impatient to the disciplined. If you're trading on margin, you can be forced to sell at the worst time right before prices surge again. That's why the narrative insists the position must be physical metal. Physical metal doesn't carry margin risk and doesn't get liquidated. If silver dips to $50 tomorrow, you still hold the same ounces, you don't lose unless you sell. The claim is that volatility is the price of admission. If you can't handle a 20% drawdown, you won't earn the 100% return on the other side. Then comes the uncomfortable question: when do you sell at $100 at $200? The argument says converting silver back into fiat dollars means you've lost. It's framed as swapping a real hard asset for a collapsing currency, like abandoning a lifeboat to return to the Titanic because you forgot your suitcase. The proposed exit isn't cash out, but rotate. You rotate from overvalued assets into undervalued ones instead of holding fiat. Right now, the script claims both gold and silver are still undervalued. And it adds that real estate is also undervalued if measured in gold, same with land. The opportunity as presented is in that rotation, ride the revaluation, then swap into assets that generate income or utility when the ratios signal it. Here's the strategy for 2026, ride the wave. Hold on to your metals while they are being revalued and let them appreciate $100, $150, maybe beyond. Monitor the key ratios. Keep your eye on the gold to home price ratio and watch the gold to acre of land ratio. That's your signal to make the swap. When 500 ounces of silver can buy a rental property outright, that's when you make your move. When 10 ounces of gold can buy 10 acres of productive farmland, that's when you rotate. You're converting static capital into dynamic income-generating assets. You don't touch the dollar for long. You only use it as a temporary bridge during the transaction. This is how European dynasties built lasting empires. They didn't cling to gold forever. They used it strategically to acquire land when chaos ruled the streets. And 2026 may present the same kind of rare window. Now let's cover one final but critical concept for the year ahead: real yields. Your broke brother-in-law might argue, my savings account gives me 4% interest. Gold gives nothing. That line is framed as proof he's the mark at the table. Sure, the bank pays 4% nominally, but true inflation, meaning food, healthcare, insurance, and energy, is framed as running 8% to 10%. That makes his real yield negative. Subtract 10% inflation from 4% interest, and he's losing 6% of purchasing power every year. He's being drained financially, but because the number in his account rises, he believes he's doing well. Gold, on the other hand, pays 0% nominally. But 0% minus 10% inflation means it protects against that 10% loss, according to the script. The claim is that gold adjusts upward, it tracks inflation, and often overshoots, delivering a real positive yield in terms of purchasing power. In a world of structurally negative real interest rates, described as inevitable because the U.S. can't sustain positive rates, gold is framed as the highest yielding safe asset. Its yield in this framing is preserving your economic future, so don't be lured by that 4% return flashing at your bank. It's called a trap the bait in the mousetrap. Everything so far, ratios, technical patterns, physical shortages, is described as the language of finance. And finance is a numbers game. But this next and final chapter isn't about numbers, it's about power. Because you can't fully understand what's happening to gold and silver in 2026 unless you grasp the war over the future of the global financial order. This isn't just a commodities bull run. The claim is, we are witnessing the de-dollarization of the global economy. And there's said to be a specific reason silver is surging at the end of 2025, not just solar panels, not even just AI, geopolitics. The opponents of the US dollar. BRICS countries, the global south, and major energy producers are framed as having found their ultimate weapon. They've realized they don't need missiles to challenge the West. The script argues all they have to do is drain the COMEX. Let's zoom out for perspective. For half a century, the world ran on a petrodollar system. For decades, Saudi Arabia sold oil exclusively in US dollars. Since the world needed oil, it also needed dollars. The United States printed those dollars, acquired oil virtually for free, and offloaded its inflation to the rest of the world. It was framed as the most brilliant financial con in modern history until the illusion shattered. In 2024, that foundational agreement supposedly collapsed. The script claims Saudi Arabia aligned itself with the BRICS bloc, and in 2025 we witnessed the fallout. Now we're said to be seeing oil transactions settled not only in yuan and rupees, but even in gold. But here's the catch. When China buys oil from Iran or India, pays Russia for crude, they don't want to hold weak foreign currencies. The example given is Russia having no use for rupees because they can't be spent on the global stage. So, what happens next, according to this narrative? Those trade surpluses are instantly converted into physical gold. That's described as the hidden force, the shadow bid that has been propping up the gold market all year long. It's framed as not being Wall Street or average investors, but nation-states settling trade imbalances in gold bullion. The reason offered is simple. They no longer trust the Western banking framework. The script points to 2022 when the U.S. froze $300 billion of Russia's reserves overnight as the turning point. That event is presented as a lesson to every central bank in the global south. If your reserves are in dollars, they're not truly yours. They're described as a revocable permission slip from the U.S. Treasury. But gold, the script argues, requires no permission and silver requires no approval. That's presented as the real reason behind the persistent Shanghai gold premium. The claim is that China is vacuuming physical metal out of the West, quietly building a financial shield against a future where the dollar becomes a weapon. In that emerging world, the script says whoever holds the gold sets the rules. So, when people ask, how much should I own, the script reframes it. Do you want the currency of an empire in decline, or the asset favored by ascending powers? It concludes, the smart money has already made its decision. Next, it attacks credibility. Central bankers are called hypocrites, and their public statements are contrasted with their actions. Examples given: Jerome Powell says gold isn't money, and the ECB calls Bitcoin speculative and gold outdated while telling the public to rely on paper assets. The script claims they pretend inflation is 2%, but actions speak louder than words. In 2024 and 2025, it says central banks accumulated more gold than ever before, and not only China, Poland is singled out as an example. Poland's motive is framed as proximity to a war zone, implying paper money won't protect in a crisis. Singapore is also described as stacking physical gold along with Turkey, India, and the Czech Republic. The closing challenge is, if gold is a useless relic, why are the most powerful financial institutions hoarding it? The script answers, they know the system is breaking. They understand the debt equation is broken, and they believe a reset is inevitable. When that reset arrives, whether currency revaluation or a new digital dollar, they'll need hard collateral to support it. They won't be able to back a new system with trust and reputation because that trust has already evaporated. The claim is they'll need to anchor it with gold. Picture this, the U.S. Treasury declares the new dollar is tied to gold at $20,000 per ounce. If you hold gold, you become wealthy overnight. But if your wealth is in paper dollars, the script says you've just suffered a 90% devaluation. It argues central banks are front-running this transition. They're buying the hedge before the crisis hits and hoping you stay distracted. The script says they want you chasing hype stocks and meme coins. Because the moment the public wakes up and buys gold en masse, it claims gold would shoot to $10,000, instantly exposing the game. So they suppress prices to buy time. Don't let them steal your seat on the lifeboat. Now comes the ominous part. The script says 2026 is the line in the sand because of CBDCs. It insists this isn't fantasy, claiming it's outlined in public documents from the Federal Reserve, the ECB, and the IMF. The claim, programmable digital money to replace cash. It says officials will sell CBDCs as convenience, security, or anti-money laundering, but the script frames that as a cover for total control. In a CBDC world, it argues your money isn't a possession. It's an entry in a government database that can be programmed at will. Want negative interest rates? The script says they can deduct 1% each month to force spending. Want expiration dates? It says they can run, use it, or lose it countdowns. Need carbon quotas? It claims a gas purchase could be declined if you exceed a monthly CO2 limit. It adds political control as part of the design. It points to examples of digital censorship and frozen accounts in Canada, truckers, and Brazil. The message is dissenters can be financially blocked. The script says this system is being built now. FedNow launched in 2023, and pilot tests for a digital dollar are already active. It also predicts cash will eventually be outlawed, citing climate threats or tax evasion as the likely justification. Then it asks, what's your exit plan? If you can't use paper cash and refuse a programmable surveillance token, what's left? The script answers silver. It calls silver the last anonymous, physical, untraceable form of money. It gives barter examples like a silver coin for a generator or a silver bar for food. No apps, no QR codes, no face scans, no permission required. This is the framing. The script says that's why they hate it. And that's why it says you must own it in 2026. Owning silver is presented not as an investment, but as a declaration of freedom. Owning silver means you can operate outside the digital matrix. Without physical metal, you're fully reliant on the grid, and if that grid shuts down, you're exposed. But with silver in hand, you still have options. That flexibility gives silver a kind of freedom premium, especially in a world governed by CBDCs, where it may trade above spot. Do you think a silver eagle stays at $70 in a cashless controlled economy? The script says try $500 or more because you're buying the ability to transact freely. That raises the question people ask, what if the government confiscates it like under FDR in 1933? The script calls it a fair concern. Back then, Executive Order 6102 forced Americans to surrender gold, but the script says 2026 is not 1,933. In 1933, gold backed the dollar, so the government needed the metal to expand the money supply. Today, the dollar is backed by nothing, and authorities can print trillions with keystrokes. So the script argues they're unlikely to go door to door for coins. Instead, it claims they'd use a subtler tactic: taxation. It predicts windfall profit taxes on metals potentially framed as taxing the rich, and it warns private metal transactions could be restricted or criminalized. How do you defend against that according to the script? Discretion, privacy, and a low profile. Don't show off holdings and don't post pictures online. It argues for small, usable denominations, naming items like silver eagles, maple leafs, or pre-1965 US. Coins as practical. A 100-ounce bar is described as more traceable and reportable, while a roll of silver dimes is framed as quiet money for daily necessities. In a confiscation-style world, the script says junk silver becomes a people's currency, minimal friction, little dependence on databases, and more privacy in everyday exchange. It emphasizes staying unobtrusive, being the gray man, so you look ordinary on paper while keeping a private buffer of purchasing power at home. We've discussed inflation and slowdown, but now the script introduces the tail risk hyperinflation, a low probability event with devastating impact. Most people say it can't happen here because the U.S. issues the world's reserve currency. The script counters so did Rome, the British Empire, and the Dutch. Every fiat currency, without exception, eventually collapses to zero. The script says the success rate is 0% every single one. It argues the current U.S. debt trajectory isn't ideological, it's mathematical and exponential. Right now, the U.S. is adding roughly $1 trillion in new debt every 100 days. The claim is that cycle soon shortens to 60 days, then 30 days. Eventually, the bond market snaps, buyers disappear, and the Federal Reserve is forced to monetize everything. When that happens, the script says confidence vanishes almost instantly. Once confidence in the dollar is gone, it claims gold moves toward infinity because the measuring unit becomes worthless. It cites Weimar Germany as an example, saying people used gold dust to buy basic food. The point is, currency collapse changes what price even means. It adds modern examples: Venezuela, gold flex used for everyday payments, and Zimbabwe people switching to U.S. dollars until the U.S. dollar becomes the next Zimbabwe dollar. If that scenario unfolds, it says a 5% hedge is meaningless and stock portfolios become irrelevant. The only question that matters becomes how many ounces do you own? It claims that if you hold 5 ounces of gold and 200 ounces of silver, you effectively become the local bank holding liquidity when others have none. With that liquidity, it says you have the capital to restart economic activity. If you hold nothing, the script warns you'll be standing in line waiting for rationing. It frames preparation for 2026 as not wanting this outcome, but following the math. The only unknown, it says, is timing. Then it compresses everything into an execution plan. First, disregard the old 5% advice and target 10% to 15% of net worth in physical metal. If you're deeply concerned about systemic risk, it says, push closer to 25%. Next, the foundation, make your first objective 5 ounces of gold and 200 ounces of silver. It urges reaching that baseline quickly by converting non-essentials into metal, selling unused items, and cutting subscriptions. Once that base is secured, it suggests moving toward larger milestones, 10 and 500, then 20 and 1,000. Structure matters too, it says. Right now, silver should be weighted heavier because the ratio favors it. A practical approach given is roughly a 2-3 to 1 silver to gold mix for new purchases until the ratio drops below 60, then rotate more aggressively into gold. Form is also emphasized: stick with physical coins and bars and avoid high-premium collectibles and numismatics. For weight and flexibility, it recommends junk, silver, dimes, and quarters for barter, and 1-ounce gold coins for concentrated wealth storage. Finally, it pushes a mindset shift: stop measuring success in dollars and start thinking in ounces. I added 2 ounces versus I made $500. Closing warning: the window to position is narrowing. It cites the Shanghai Gap dealers selling out and limit up halts as tremors before a bigger move. The message ends with urgency. Metal is still obtainable right now if you know where to look. You can still exchange your paper dollars for silver, even though premiums are elevated. But a moment is approaching, maybe in days, maybe in weeks, when silver will vanish from shelves entirely. Dealers will be sold out, mints will halt production, the buy button will be disabled. And on that day, society will split into 2 groups: those who own physical metal and those who don't. Don't be the one calling me 6 months from now saying, "Where can I still buy silver? I won't have an answer, nobody will." You already possess the information. You've heard the warnings. You know what the targets are. Now all that's missing is your action and your courage. Because yes, it takes courage to go against the herd. It takes conviction to move money from your safe bank account into cold, silent metal that offers no yield. It takes bravery to step outside the system and become your own central bank. But look at what's happening around you. The debts are exploding. Conflicts are spreading. The lies are louder than ever. Do you really trust their financial system? Or would you rather hold the one asset that has outlived every regime, every economic collapse, and every currency experiment for over 5,000 years? That choice is yours, but time is running out. Get your financial house in order. Secure your 5 ounces of gold and 200 ounces of silver before they lock the doors. We at Currency Archive are grateful you're walking this path with us. If this message resonated, subscribe, and most importantly, share it. Wake up your circle. Wake up your community. We're building a lifeboat. There's still room, but the water is rising quickly. Stay sharp, stay prepared, and we'll see you on the other side of the reset.